For decades, oil has functioned like a high-compression engine of global power. And, few places demonstrate that more clearly than Venezuela. After years of sanctions and chronic underinvestment hollowed out production, the crisis hit a breaking point in January 2026, when United States forces captured President Nicolas Maduro during a military operation linked to a broader effort to secure control over Venezuelan oil assets. Instead of stopping exports outright, the pressure triggered rapid adaptation. Tankers vanished from tracking systems, trade routes shifted under threat, and buyers recalculated risk. This wasn't simply a blockade. It became a real-time stress test of maritime logistics, refinery compatibility, and global energy strategy. These are the developments, tactics, and outcomes now reshaping the oil market. What Washington attempted wasn't a routine sanctions announcement. It was a hard stop. Ships were halted, cargoes frozen, sea lanes controlled in logistical terms. That's the difference between saying we'll penalize you and declaring we'll physically govern the route. So, the Caribbean isn't just postcard water, it's actually a critical artery feeding refineries, storage hubs, and all those re-export loops. And once naval enforcement enters the picture, every ship owner, insurer, and buyer, they recalculate risk instantly. But blockades look clean on briefing slides and, honestly, pretty messy at sea. International waters, flags of convenience, layered ownership, and those constantly changing vessel identities, they really complicate enforcement. Boarding actions might deter activity, sure, but they also expose limits. Every single interception carries headline risk and, escalation questions. That uncertainty, it created room for arbitrage. Markets hate fog, but let's face it, they thrive on opportunity. Once the blockade began, the system didn't just freeze, it adapted. Venezuelan oil flows didn't disappear. They reconfigured, turning the Caribbean into a high-stakes chessboard where, really, every move invited a countermove. And once physical enforcement showed its limits, the real contest shifted, from ships you can see to signals you can't. No submarines involved. The disappearance was electronic. AIS transponders went silent. Kill the signal, and you create a monitoring blind spot the size of the ocean. Think of it like disabling GPS, except the object is a floating steel skyscraper hauling 1 million barrels of crude. Maritime surveillance is pattern-based. Break the pattern, and oversight lags. So, this playbook isn't exactly new. Iran and Russia, they really perfected it under sanctions, building these shadow fleets that now operate almost like a parallel supply chain. Venezuela, they tapped into that same ecosystem. We're talking about aging hulls bought cheaply, shell company ownership, permissive registries, and honestly, minimal transparency. Even when a vessel is visually confirmed, proving cargo ownership and jurisdiction can actually take longer than the voyage itself. Success, it compounds fast. Routes become more refined. Transfer points get optimized. Paperwork is standardized. Dark mode isn't just a trick, it's an operating model that, frankly, forces enforcers into permanent catch-up. Before we go any further, could you do us a quick favor? Just hit like and subscribe. It really helps us reach more auto enthusiasts just like you. Now let's shift gears, because what's moving through these shadow routes isn't interchangeable fuel. This isn't theater, it's hardware. Venezuelan grades like Murray are heavy, bitumen-rich barrels. Many refineries are purpose-built machines, cokers, and hydrocrackers designed to run that feedstock. Swap it overnight for light shale and yields collapse, margins shrink, and product slates break. Heavy crude underpins diesel supply chains and industrial fuels, especially in China. Bitumen supports paving and construction. Remove those barrels, and very specific machines feel it. For Venezuela, oil isn't optional. It's really the economy's crankshaft. Export revenue funds imports, stabilizes services, and, keeps the lights on. When boxed in, systems innovate. The policy shift followed. Instead of absolute blockage, management took over licensed trade, intermediated barrels, and marketing through trading houses. U.S. refiners quietly re-entered via middlemen, tempted by deep discounts and, honestly, just simple refinery math. One heavy barrel is hard to replace, and keeping refineries efficient often means dealing with reality. Either shut flows down completely, which is, well, pretty rare, or steer where they land. Pragmatism won, and nowhere is that recalculation clearer than in China's long-game approach. You know, China has long been the largest destination for Venezuelan oil, mainly because it can absorb those discounted barrels and process heavy grades through its independent teapot refineries. For Beijing, Venezuelan crude isn't just about supply, it's actually leverage. Each additional source, honestly, reduces exposure to choke points and political pressure. Discounted oil doesn't just help with energy security, it actually turns it into a real cost advantage. So, recent developments have definitely altered the short-term picture. Blockade pressure and tanker seizures slowed departures, forced turnarounds, and cut near-term flows to Asia. But this wasn't a defeat. It was really just an adjustment. China stocked up earlier, filled its storage, and reduced the urgency. The real edge is flexibility. Even when volumes dip, sanctioned oil can still reach Asia through blending and re-export routes. If teapots face shortages, they pivot to Canadian heavy blends, for example, triggering shifts across global sourcing. The automotive and industrial sectors should be paying attention. But China isn't the only actor adapting. The most revealing shift may be happening inside Washington. The real pivot wasn't tankers going dark. It was strategy evolving. A blockade implies total denial. Instead, policy moved toward managed trade licensing, clearing stranded cargoes, bringing major trading houses back in, and encouraging selective investment to revive output. That isn't shutdown, it's control, taking hold of the tap and deciding who gets fuel. Zooming out explains why. Venezuela's infrastructure is worn and heavy crude is expensive to produce. It requires heat, diluent, aging pipelines, and constant maintenance. Even modest output gains won't flood markets, but they can rebalance key refineries, giving small increases outsized political impact. Caribbean staging completes the shift. Routing barrels through hubs like Curaçao and St. Lucia decouples origin from destination. Once staged or blended, oil becomes harder to politically label. Trade flows restructure, and as control moves from oceans to data, the next phase of conflict is already underway. When transponders go dark, enforcement becomes a technology war. Agencies lean on satellite imagery, pattern analysis, port monitoring, financial tracing, and intelligence coordination. Synthetic aperture radar can detect ships through darkness and storms. Analysts flag loitering, mid-ocean transfers, and suspicious documentation. Even with advanced tools, the ocean remains vast, and enforcement resources finite. Recent seizures prove the pressure is real and rising. Boarding tankers sends shockwaves through insurers, owners, and registries, but it also creates a whack-a-mole effect. Ships rename, reflag, reroute, and hide behind legal complexity. That's why shadow logistics isn't a temporary workaround. It's a durable system. This wasn't just a clash between tankers and warships. It was honestly a stress test of modern power. The Venezuelan oil blockade exposed the limits of raw control in a world governed by logistics, incentives, and interconnected markets. The United States showed it can seize vessels, redirect trade, and influence flows, but only with compromises, trade-offs, and, unintended consequences. Venezuela showed that even a weakened producer can survive by exploiting gray zones and rival interests. And the oil market did what it always does: adapt, reroute, and resist total control. For the automotive and energy worlds, this matters deeply. Fuel supply chains, refinery economics, and geopolitical risk are now inseparable. The road ahead won't be defined by who commands the biggest fleet, but by who understands the shadows and builds systems resilient enough to operate inside them. Now let's hear from you. Are shadow shipping networks making sanctions ineffective, or simply more expensive? Should refineries and automakers prioritize flexibility over efficiency going forward? And how do you see this reshaping fuel prices and manufacturing costs in the years ahead? Drop your thoughts in the comments. And if you want more deep dive breakdowns like this, subscribe to Piston Pundit so you don't miss upcoming vehicle updates and analysis. Thanks for watching.